I'm Aradhana Kejriwal, the president of the Atlanta Society of Finance and Investment Professionals. I welcome all of you today to our first Asset Owner Series in Atlanta. I want to give a special thanks to our host, Invesco, for graciously hosting and sponsoring today's meeting, and also to Mike Paul and Todd Page for making this event happen. So thank you so much from PowerShares. Thank you. Before we get started with our event today, I want to talk about two of our highly anticipated events that are coming up and would love to see all of you attend those as well. On March 28th, we have lunch with Dr. Raphael Bostic, who's the president of the Federal Reserve of Atlanta. It's at the Bucket Club, and this will be one of his first few public appearances with us at the Atlanta Society. On April 26th, we have our annual Future of Finance conference and at the Grand Hyatt, and we would love to welcome all of you to that. We have a great lineup of speakers. We have Carla Harris, we have the sketch guy Carl Richards from New York Times, we have Jeffrey Tobias, and a whole list of speakers to talk about the FinTech panel. So would love to see all of you over there as well. For today's event, which is the Asset Owner Series, and we are absolutely delighted to have our first one here in Atlanta. The Asset Owner Series is essentially a collection of exclusive events for the investment industry, executives that are looking to improve their asset management strategies. It was started by the New York Society, the CFA Society in New York, and we have Kevin Maxwell, who will later on give you a good description of what the Asset Owner Series is and how they're spreading the word across the United States and across the world. I believe they've just recently partnered with the Hong Kong Society and have hosted an Asset Owner Series over there. All right, before we get there, let me introduce Ben Utt, who is the head of U.S. institutional sales at Invesco. He's been with Invesco for 21 years, and he's played various roles here. Right now, he is the head of institutional sales, managing director of North American institutional sales, and executive vice president of Invesco Distributors. Welcome, Ben.
I just want to welcome everybody to Invesco. It's good to see a lot of familiar faces here too. Atlanta has actually been our worldwide headquarters since our founder, Charlie Brady, back in the 1970s, actually started Invesco with 8 other partners when they bought out the old asset management division of the Citizens Southern Bank, if y'all remember them. And they started Invesco with $250 million in assets. Today we're $950 billion global investment money manager with local expertise in 22 countries around the world, with a full spectrum of solutions and strategies, from cash to private equity, that we can offer out in separately managed accounts, commingled trust, mutual funds, and ETFs. I think one of the unique characteristics of Invesco since our very start has just been the singular focus on investment management. All we do is investment management. We don't do any banking, we don't do any insurance, so every resource here is really just for the benefit of our clients to provide some solid performance and outstanding client service. So we're happy to host you here today. Glad you're visiting, and also want to bring to your attention, because most of you should be receiving an invitation to a May 17th event we have here, the Invesco Leadership Exchange. We'll have former 4-star General Stanley McChrystal here to talk about lessons in leadership. So take a look at that. Y'all have a great day, and thanks so much for being here at Invesco.
Thank you, Ben. Next, I would like to introduce Kevin Maxwell. He has come from New York to join us for the Asset Owner Series. Kevin Maxwell is the Managing Director of Institutional Advisory Services for Nuveen TIA. He's an active member of the CFA Society of New York, where he currently serves as a board member. Mr. Maxwell also serves on the editorial board of the Institutional Real Estate Letter and is the past chairman of the Publication Committee for Pension Real Estate Association. He formerly served as the chairman of the Corporate Governance Committee of INREV. He has a lot of articles published in the Journal of Property Management and PRIA Quarterly. He is from the he has an accounting degree from University of Illinois, MBA, CPA, and a CFA charter holder. And he's specially joining us from New York to talk about this event. Welcome, Kevin.
Thank you very much for the warm welcome and also the warm weather. As you probably heard, we got a lot of snow and cold weather. It's always great to be here. I see a lot of people I know, Willie Whipple, who used to work alongside of me for a long time, and a lot of others. I've come to Atlanta often. So I'm really glad to be here. I am a member of the board of the CFA Society of New York, and you know, it's funny how things are so different. All of our meetings are at night. To come to a meeting at lunch, this is really great. Of course, you know, New Yorkers, I'm originally from Chicago, but New Yorkers, you know, they work all day and then they go and they work again. So in other words, it's nice to be here. Our society is a little bit different. We have 13,000 members. We are the largest society in the world. And because we teach CFA study classes, we have our own auditorium. So it's great that Invesco is sponsoring this event. But we have all our events right in Midtown and in Times Square. So it's sort of nice to be able to get to know people and see the offices and that kind of thing. I am a managing director of TIA, and my focus is on alternative assets. And I've been a CFA for over 20 years, and I was asked by the Society of New York a few years ago to get re-involved, and they were nice about it. They didn't say, well, we want some older guys or gals involved to get re-involved. They just said, oh, we like some experienced people to get re-involved. And so it's been very fun. I used to go down to the World Trade Center. Of course, that doesn't exist anymore, but get re-involved. So this is your inaugural Asset Owner Series event. And the Asset Owner Series was an idea of a few folks, not myself, I joined it later, in New York in the year 2015. And we said we have so much money managed by a lot of our members and guests. What if they would come in and talk to us about what they do? So I'll pick on New York's City of New York retirement system, $150 billion pension plan. Scott Evans, who's the CIO, actually used to be the CIO of TIA. I know him very well. He came and spoke to us about how they invest their money. It was very interesting. So we've put together a series of events called the Asset Owner Series, AOS, and we have 7 a year, and we've done them now for our 3rd year. And so 7 times a year, we have different asset owners come and talk about what they talk about. So for instance, the public funds group, which Scott Evans, the CIO, came and spoke. He was just one of a series of panelists. We also do one for corporate pension plans. Then we do another one for sovereign wealth funds, and then one for national pension systems. Then we do one for single family offices, and we do one for multifamily offices, and eventually we do one for consultants. We've had over $38 trillion come and speak to us about what they do. And so someone came up with the idea, well, geez, what if we reach out to other societies and see if they might be interested? And so we've put together this loosely grouped federation, if you would, and Atlanta's one of the founding members of the federation. I'm glad to hear that, and that we're here. Also another founding member is Hong Kong and Japan. And later in the next few months, we're going to have France. Again, some of the societies are countries. So France or Japan, it's a country society. A lot are cities. So also Philadelphia, Austin, Columbus, and Seattle, and the Emirates are going to join. So I just wanted to say I hope that you continue to do this. Not only is it very informative, sometimes it's really hard to find out what these plan sponsors, major asset owners are doing, but it's also a great networking opportunity. So with that, I thank you for having me.
This is great, and we're really excited to hear the panelists. I'll introduce Joe Beatty. He is part of our programs committee and has been an integral part of organizing this event and putting the speakers together, along with our VP of Programs, Natalia. Joe, would you like to come and introduce the panel?
Good afternoon, and thanks again for Invesco to invite us to have this event at their facility. This is a fabulous location, and if you want to see what the markets are doing, just look behind you. It's all going on right there in their trading room. I'm one of the volunteers on the program committee, and essentially at CFA Atlanta. We worked together to create this event, and we hope you find this relevant to your practice. This is a great collection of talent assembled today for Atlanta CFA version of Power Lunch, if you want to call it that. Let's introduce our panelists. On my right, starting off with Tony Daniel with LCG Associates. Tony joined LCG in 1998, and he is a member of the board of directors of the firm. He serves as a team leader, consulting to a number of corporations, nonprofits, and healthcare client relationships. Previously, he was a consultant with the asset consulting group of Towers Perrin in Atlanta, now Willis Towers Watson. There, he was responsible for investment management research, including quantitative and quantitative analysis of investment management organizations and investment-related issues. Tony received his BS degree in finance from Birmingham Southern College. He is a CFA charter holder. Additionally, Tony is a member of the CFA Institute and CFA Atlanta. Geoff Hobbs is next. Geoff is an insurance portfolio manager with Voya, acting as liaison between Voya Investment Management and the U.S. insurance company clients in the investment of general account assets. Prior to joining the firm, he was a portfolio manager at 4086 Advisors in Carmel, Indiana. And Geoff earned his BBA in finance with honors from the University of Oklahoma and an MBA from the University of Chicago with concentration in analytic finance, corporate finance, and economics. He holds the CFA designation. Next is John Glidden. John is responsible for Delta Airlines defined benefit and defined contribution pension plans. In this role, he oversees asset allocation and plan level risk management. John works with outside consultants in the selection of oversight of the active investment managers. Prior to Delta, in 2011, John was Director of Manager Research at Wilmington Trust. There he constructed and provided oversight of multi-manager portfolios across both traditional and alternative asset classes. John was also a member of Wilmington's investment strategy team, which set strategic and tactical asset allocation for Wilmington's clients. Prior to joining Wilmington Trust in 2007, John spent 6 years with Emory University's Endowment Fund. John holds a master's degree in financial mathematics from the University of Chicago, a master's degree in business administration from Emory University, and a bachelor's degree in mechanical engineering from Georgia Tech. He served our country as an officer in the U.S. Navy from 1994 and 1999, including Tomahawk missile officer and weapons and boarding officer. John is a member of the Atlanta Society of Financial Analysts. Mike Negussie with Emory Investment Management is next. Mike joined Emory Investment Management as Director of Investment Risk in September of 2017. Before joining Emory, Mike worked for MSCI as Vice President, covering asset owners for their multi-asset class investment risk analysis needs. Prior to MSCI, he worked for CSAA Insurance Group and Partners Healthcare System investment programs for over 9 years in a variety of investment management roles. Mike holds an MBA and a BS in finance from the University of Massachusetts, Boston, and is a CFA charter holder, and most recently moved to Atlanta from the Bay Area. Syed Haque, Director of Public Markets at UPS Investment Group. Syed serves as the Director of Public Markets for United Parcel Service, where he maintains investment oversight for $30 billion of public investments, which include global equity, fixed income, hedge funds, and derivative overlays. His responsibilities include portfolio strategic allocation, portfolio management, manager selection and due diligence, risk management, and performance monitoring. In total, the UPS Investments Group is responsible for approximately $36 billion in assets held for the UPS defined benefit plans. Prior to his current role, Syed was the global equity portfolio manager for the plan, where he had oversight of approximately $12 billion in equity assets. In his prior role, he shifted the global equities portfolio away from a traditional approach to factors-based approach so as to more fully optimize the risk-adjusted returns. Before joining UPS Investments, he was Senior Investment Risk Analyst at Emory Investment Management, where he was responsible for design and implementation of risk analytics and systems across all asset classes for the endowment portfolio. He is an MBA graduate of Duke University Fuqua School of Business and received his MS in Computer Science from George Mason University and a BS in Civil Engineering from Indian Institute of Technology. Kipp Reck, Southeast Investment Leader for Willis Towers Watson here in Atlanta. Kipp joined Willis Towers Watson in 2008 and brings over 20 years of experience in institutional investments to his interactions with his clients. Kipp served as an investment consultant for large institutional investment pools, including both defined contribution and defined benefit plans. He has experience with asset liability and risk strategy consulting for large pension plans, including dynamic de-risking and risk budgeting. Kipp also has knowledge of investment structure and hedging strategies for large corporate non-qualified deferred compensation plans where corporate assets are earmarked for benefit payments. Kipp has worked on the design and implementation of ERISA compliant governance and due diligence processes for qualified retirement plans, including committee structure, investment policy statement, ongoing monitoring, and due diligence. Kipp earned his MBA from Rollins College in Winter Park, Florida, and a BA in finance from the University of Iowa. Kipp is a CFA charter holder and member of the CFA Atlanta. With that, that is our panelists, and let me go back around and starting with Tony. Take a minute, Tony, and just describe the firm you work for, types of clients you work with, the range of clients that
Sure.
you're involved with.
You bet. So, yeah, LCG Associates, we're headquartered here in town. We have offices in Dallas and Seattle. Our client base is located throughout the country, so we have about 82 clients. That represents about $94 billion in assets. If you break down our business, if you will, call it a third in corporate plans, kind of equally weighted between DB and DC assets. Typically, if we're working with a pension plan, we're working with a defined contribution plan. Call it a third endowment and foundation with a tilt towards educational institutions. And then the balance is high net worth or family office, investment platforms, and then healthcare institutions as well. We don't do public funds, we don't do Taft-Hartley funds for various reasons. If you look at the average client size, it's about 1.1 billion. If you look at the median, it's about 307 million. So we do get into some very large plans, and then we do get into some smaller plans as well. This is all that we do as investment consulting. We would note that we've kind of eliminated the conflicts of interest associated with our business. So every nickel that comes in the door are hard dollar fees that are paid by our clients. And not surprisingly, a lot of the things that we do related to asset allocation, investment policy, manager due diligence, those are all part of that, but we really consider ourselves an extension of our client staff. They've chosen to hire a consultant as opposed to build it within. And so, we really think that's important. We do both discretionary or OCIO work, as well as non-discretionary. And I think the real theme of our firm, 2 points, and I'll move on, we're a firm of analysts. So when I say that, all of our senior folks are heavily engaged both in capital market research as well as manager due diligence. We think that makes for a better translation to client portfolios, and the theme, and again, that we think is important is customization for each client. So we listen more than we talk. We try to, even though we're consultants, and really try to understand what the unique drivers are for each one of our clients. So that's kind of a quick profile. My responsibilities are management of those relationships, governance of the firm, business development, and a number of other things. So,
great job. Geoff, let's hear about Voya.
Yeah, so Geoff Hobbs, I'm Senior Insurance Portfolio Manager at Voya Investment Management. Across the firm, Voya is a top 25 manager of tax-exempt and DC assets with about $230 billion of assets under management. Voya Investment Management has a 40-year history in investment management. We run our fixed income here out of Atlanta, which is the lion's share of the assets. Voya Investment Management is a subsidiary of Voya Financial. It's an NYSE-listed company that has investment management, insurance, and retirement services solutions offered. The company has about a $9 billion market cap. Day to day, I work on the proprietary insurance portfolios of the general account. That means I only have one person to yell at me, which is our own balance sheet. I don't have third-party clients, although we do manage third-party funds, obviously, at at Voya, and that's about a $90 billion portfolio run almost entirely out of Atlanta. Some of you might know Voya as the former ING. So we spun out of the Dutch bank ING in 2012. Voya IPO'd in 2013 and is now fully standalone business here.
It's great to have you here, Geoff. Very infrequently are insurance assets considered part of an asset owner series, so it's nice to have the viewpoint of different duration assets, if you wish, that you bring to the table.
Yeah,
so.
we're long duration, and like I said, you know, it's a captive client of mine, so they don't let me out much. But today, you know, I'm here, so thanks for having me.
We're glad you're out. John with Delta, let's hear a little bit about.
Great. Yeah. Good afternoon. I work with Delta Airlines. We run a couple of flights out of the South Terminal at Hartsfield Jackson. I run the pension investments. That's both on the DB side and on the DC side. I'm planning on keeping my comments to DB today, but I'm happy to talk about DC if there's any questions. I guess first thing to know on the DB side is that Delta froze when we came out of bankruptcy. So this is late 2005, early 2006. So we've been frozen for 12 years. I think that'll contrast nicely with what you're going to hear from Syed in a little bit. A couple of vital signs just to give you an idea of where we are. We closed 2017 is a $15 billion DB plan. We were 68% funded, which might not sound great, but that's the highest number we've been for quite some time. Our unfunded pension liability is $7 billion. Also not great, but it's better than 13, which is where it was not too long ago. Our spending rate is about 8%, and we've got a high, still kind of a growth mindset, a high expected return on assets, and quite a low liability hedge ratio. I've been at Delta for 7 years. Delta's really kind of seen it all as it pertains to pensions, and I'll be happy to dig into any of this. It wasn't that long ago, kind of 1999, 2000, Delta had a large internal pension staff, and that large internal pension staff had their own title system, their own compensation system, their own space, fully insourced, probably a team of 25. You had 9/11, you had the bursting of the tech bubble, you had Delta's kind of march towards bankruptcy. There were a lot of staff attrition at the time. Coming out of bankruptcy, there's no tolerance for different compensation systems. You had to live within the corporate title and compensation structure. Delta completely outsourced their plan in 2007. So there were kind of 0 full-time employees around that. That's how we were going through the financial crisis. The health of the company began to improve. They brought me on board in 2011, and now we're kind of a hybrid. Our funded status could definitely still use some improvement. We need to get that a little bit better. But now I've got a team of 5 people, and we had an OCIO model, so we can certainly talk about that. Now we have more of a hybrid model. It's not a full internal team. It's not full outsource. We can talk about that. Maybe some of the more interesting things that we could pick up on later is we can talk about we can certainly talk about the governance aspects, and that covers a whole lot of things. There's with a high expected return, we trade a fair amount of derivatives, which can get a little bit complex. So how do we ensure that our investment committee maintains control and has good intuitive understanding of what we're up to? That's a big thing. Contribution strategy is something that I don't think gets talked about nearly as much. It's a little bit of a pension thing, but I think you can expand it. You got cash going in, you've got your investments, you've got cash going out. You really need to model all of those. For Delta, I guess one of the vital stats I left out, the liabilities is 60% of the market cap of the company. So pensions really matter for Delta. So thinking about that contribution strategy, pensions is more an exercise in enterprise risk management for Delta Airlines Incorporated than it is purely an investment endeavor. We do portable alpha in pretty significant size, where we try to maybe trade off a little bit of equity beta for a little bit of a higher allocation to non-correlated strategies. So call that market neutral strategies, alternative beta strategies. We could talk about any of that. We do use tail risk management, and we do use trend and other kind of strategies that may have a negative correlation with equities. And we can talk about that as well. This idea of controlling beta is very important to us. And I can also talk about managing a private portfolio with a frozen plan. Again, Just one last data point and I'll move on. So I mentioned Delta froze in 05 and 06. Our pension benefits, and it was a hard freeze. There's, one day you were accruing benefits, the next day nobody accrued any benefits and no new plan members. Our benefit payments don't peak until 2027, to just give you an idea of the long tail that pensions have. So if you hear some of the publics talking about maybe it's time to freeze the plans or whatever, these things take a very long time.
Thanks, John. Let me turn it over to Mike with Emory Investment.
Great, thank you for having me today. So I'm part of the Emory Investment Management team. We are about 20 plus team members managing a little over close to $7 billion in the endowment accounts, the endowment of the Emory University. The portfolio is very diversified. We have almost close to 10 sub-asset classes and over 300 fund managers. And I'm part of the asset allocation and risk team, where our job is really capturing the systematic and non-systematic risk of all those individual investments and aggregating the whole thing up and trying to get the overall picture of the portfolio. And once we have that picture, we work with the investment staff to see where areas where we may want to adjust in terms of tactical asset allocation decisions. But a strategic asset allocation decision is done once every 3 years or so, so we don't really play around with that a lot, but tactically we do make some calls using derivative positioning and other instruments. In terms of anything else, in terms of the plan, it's mostly, even though it's 10 plus sub-asset classes, at the end of the day, it's heavy on growth assets. So as part of the asset allocation and risk team, our job is to see ways to diversify that in different ways without really compromising returns. I've been doing this for a little close to 6 months, but I've been in the industry over 12 years, working with different clients, so I hope to bring different perspective to this discussion as well, given my experience.
One question, Mike. Are you involved with only endowment assets, or are there other assets within the Emory complex that your team's involved with?
That's a great question. So we only manage endowments. There is a short-term investment pool of about $2 billion that's managed by the traditional treasury team. It's mostly short duration investments that they make.
Syed with UPS.
Hello everyone, so I'm part of the pensions group. So we manage money for 3 defined benefit plans. The biggest one is the management employee, which is over 50% of the assets. And then the 2 others are union plan. One of them is the Teamsters, and then the third one is the part-time union employees. They all are in different paths. The management employee, which is the biggest one, had been closed for some time, and now there is a path for it to be frozen in less than 5 years. The assets have grown quite substantially. I think the number that I gave you is slightly off. We are now north of 41 billion in total assets. The liability is slightly higher, but again, all these plans are very well funded as of now, somewhere between 95 to 105. The 2 union plans are still open, and before, till the end of the last year, all 3 plans were managed in the group trust with similar asset allocation. With the management employee now being frozen in less than 5, the path for that is changing a much higher hedge ratio. So that plan is running now as of now over 50% hedge ratio. So definitely a much different path. The other 2 plans which are open, so have, I would say, somewhere definitely below around 25% hedge ratio as of now. And then they still have a pretty decently high expected rate of return. And the group has grown quite a bit. When I joined in September 2010, we were around 6-7 people, and it has grown up to 25 people. So And we manage assets quite, internally on the equity side, quite a bit of assets internally. The whole goal is to, as much as possible, try to understand portfolio internally. And then in the case of where we don't have the bandwidth, we will go to the manager side and hire managers. On the fixed income portfolio that we manage, it is mostly a long duration portfolio because, as John mentioned, I think in your case 27. For us, we peak around 33. So it's a long tail. The duration of all the three plans are somewhere between 16 to 19. And then the fixed income asset that we have is around 17 and over duration assets. And then we have a pretty large derivative overlay program. Again, it has a multi-facet, reasoning. One is from the hedging side, and the other is from return enhancement. So we look from both sides. And again, right now, especially given the funded status where we are, there is a strong desire to preserve that. So there is definitely, the team is pretty active on that side. I can talk more in details on any of these or the factor portfolio that we have built in the discussions.
One question, Syed. With the advent of the plan freeze, and I realize it's 4.5, 5 years out, do you see things changing dramatically from an investment perspective for the assets that you manage?
For that plan, yes. So to give you an idea, when we ended last year, our hedge ratio for all the plans combined was around 21%. Now, fast forward, not even 3 months, and for that retirement plan, the hedge ratio is 50%. So it has changed substantially, and it's going to be changing. Given that as you get closer to the frozen date, the desire will be much higher fixed income allocation, and to, as much as possible, preserve the funded status.
Thank you. Let's turn it over to Kipp Reck with Willis Towers Watson in Atlanta.
Thanks, Joe. Again, my name is Kipp Reck with Willis Towers Watson. I have been with Willis Towers Watson for about 10 years and in this business for, I hate to say it out loud, approaching 25 years. Joe and I were laughing earlier. At some point in my career, not too long ago, I woke up and realized I'm the old guy in the room. I'm not sure how that happened. Been doing a long time. Our firm advises primarily for-profit corporate clients from a global perspective. We have about 700 employees around the world that have different roles between asset research, manager research, investment strategy, risk management, client consulting, delegated operations, platform, funds management, a wide variety of solutions that we bring to the market. In the United States, we have about 150, 160 employees in different parts of the country. Atlanta, Chicago, New York are the largest offices. And we provide consulting services to defined benefit and defined contribution plan sponsors. Well, our roots are in the defined benefit pension space. And so the legacy part of our business still overwhelms the assets and the client numbers from a defined contribution space. But as the industry changes, our business line changes. We provide those solutions to our clients on either an advisory basis, a retainer basis. Some clients hire us to just do projects. You've got a number of asset owners here on the panel today that have large internal staffs, lots of capabilities. Some of those clients we support, sometimes we don't. One of the things we do for a lot of asset owners is some highly customized modeling, where you can build asset management teams internally. Some of the tools that we built to deliver those solutions are hard to build and maintain internally. And so we flex the services that we provide. I'm looking forward to learning more about the audience and your backgrounds and the questions that you asked today to help kind of tailor my comments to the areas of interest. One of the things that John mentioned, and I'll spend just a minute on this and then stop talking. In the pension space, it's a very different environment than a lot of other asset pools, definitely different than individual investors and retirees or persons building portfolios to fund retirement. And the way we advise clients, really, we think in terms of pension risk management. And so we focus on the surplus, the extent to which the plan is funded or underfunded. And we help clients manage. And we really advise around three. If you think about the three tools, if you're underfunded, you can put more money in the plan. Corporations have that ability, some don't. You can increase the risk of the plan, so you can find a way to have the markets help you fill in that gap, or you could just wait. So you have time, risk, and cash are really your three levers. And so we take all three, put all three on the table to advise our clients. I know we're talking mostly about the investment support, asset management, but it's important to keep in mind those are some very big differences, and I think things that drive a lot of the panelists today, and certainly the work that we do for our clients.
One question, Kipp. Does the actuarial side of Willis Towers Watson essentially benefit some of your casework as it relates to advising clients?
Absolutely, because we advise our clients, the actuaries focus on the liability side, plan design and plan delivery, benefit delivery, and my group, my team is really focused more on the asset side. And so having that, those two groups that we can bring together for some clients does help. Yeah.
Great. A little bit of the structure today. We've got some questions already kind of pre-programmed, but we certainly want to encourage the audience to ask questions from time to time. So get your thoughts and ideas together as you hear some of the panelists speak, and we'll go from there. First question is directed to Mike, Syed, and Tony. And the question is current trends in asset allocation and risk management, and looking either at your existing plan or your clients. So why don't we start off with Mike with that?
Sure. So as I stated during my introduction, a strategic asset allocation is done once in a while, every 3 years or 4 years. And for endowments, it doesn't really change much. When you think about endowment, and when you look at pensions, there is strong liabilities that you have to be aware of. For endowment and foundations, that liability is really spending policy, and knowing how much you are expected to spend. In our case, for the universities, in the form of scholarships or what have you. So we have very little liability, and we could afford to be very long-term investors. Because of that strategic view doesn't really change, year to year. In terms of tactical asset allocation is where risk management comes in play. Actually, risk management also comes in play for the strategic one, because that strategic asset allocation is set by investment committee, and there are some bounds, and we want to make sure that risk is done to make sure that things are done within that bounds that's given to us. So in terms of, just to touch on tactical asset allocation a little more, when you invest, one thing that I didn't make clear is we use 100% external managers to invest. We don't manage money in-house. And that means sometimes we don't even know we don't have access to what we hold. So we have to work with the investment staff, we have to work with different sources that we may have, trying to capture at least the systematic risk of the investment that we make. If we take an example of credit, right? Alternative credit has been an area where a lot of asset owners have been investing recently. As you know, after the financial crisis, banks start lending, and fund managers start to fill that gap by coming up and being a funding source. So we have investments in alternative credits. So, when you roll everything up, at the end of the day, what you are taking is credit risk, default risk, and to some extent a little bit of interest rate risk, but the interest rate is often small. So, capturing that systematic risk and making a good assumption how much that default risk or specific issuer risk could be, and rolling all that up to give us a holistic picture of the portfolio. To do that, we use a simple measure, beta. So at the end of the day, we want to understand the sensitivity of our credit investment to our investable universe within the equity market to come up with one measure. So that's a big number that we have that we manage to, and we look at our benchmark as well, and to give us a very good insight of whether we are too risky or a little, less risk versus the benchmark. But once you have that picture, you could do a lot more, right? You could drill further into the different factor structure and look at by different blocks, because it looks like fixed income and equity, but at the end of the day, you have different nuances within those asset classes in terms of the driver of risk, in terms of factors. You could look at it by geography and understand how much tilt you are taking, and making sure that that tilt is measured in well-adjusted ways. Because if you are overweight equity by 5% and underweight fixed income by 5%, the two asset classes have different volatility. So your equity overweight is a lot more meaningful than the underweight in fixed income. So I just was and decide whether, and overlay valuations to some extent, decide whether we want to overweight and underweight. That's how we integrate the asset allocation and risk in a holistic way and work with the investment stuff.
Share with us what the asset allocation is currently at Emory, as far as just kind of big picture.
So big picture, it's about 70% growth-oriented assets, whether it's 40% fixed income, 10, 20 between venture and traditional private equity, private real estate another 10%, and very small fixed income, about 5 to 6% fixed income. The remaining is hedge funds and cash. The hedge fund book is quite diversified within global macro managers, bottom-up fundamental relative value managers, multi-strategy managers, and alternative credit managers.
What is currently the spending policy?
It is, if I remember correctly, it's about 5 or 6%, and that's something that's outside of the investment staff's control. But I think we have liquidity model to make sure that we are more than ready to meet that, and we monitor that. But that's less of a concern to us.
What do you think, based on 5 or 6% spending, what is the sustainability of that spending policy if you didn't get another contribution into the fund?
We feel very comfortable. The portfolio is well positioned. It has grown well over the last 10 plus years, and I think our investment we make tend to be very long term. We may have a short-term drawdown, but we think over the long run, our portfolio is positioned very well to grow, but also to maintain that liquidity if needs be. So I think we feel very comfortable.
Great. Let's turn it over to Syed, and the question is current trends in asset allocation and risk management.
So let me go to the risk management first. So risk management, again, one thing I say, because I spent couple of years in Emory, so generally the risk management, people think about that as a reporting, it's more of a risk measurement, not the management. So in the UPS, we definitely think risk management much different from the risk reporting. It is like to take the risk information and use that information to manage the portfolio. So again, you have to have the right skill set. You need to have the people with those skills. You need to have the tools. So to give you an idea, we have all the portfolios, I would say roughly 80% of the portfolios are overnight loaded into our systems. So we have an intraday, like we know portfolio what it's doing on any day. To give you some, like Aladdin, BlackRock Aladdin we use for the enterprise. Then on the equity we have another Bloomberg port, on the fixed income point. So we use all these different tools to take, that's more on the tactical side, to take any kind of decision that we make. Going back to the strategic asset allocation, it does, for us, especially going forward, it's in the liability context, you have to be aware of that. Before, I would say we used to have a pretty decent ranges in the asset allocation, so a tactical decision can be made. But for one of the plan, we can say that going forward, it's the asset allocation will be defined in terms of liability and how, the funded status. Because if I go back 2-3 years back, our mandate was just, there is certain return expectations. Now, every conversation I'm having, there is a component coming into discussion is, what about the funded status? Because that directly impacts the balance sheet. So the asset allocation, as the long-term asset allocation is changing for the biggest plan every year, given these changes. But at the same time, the two open plans, we do have an asset allocation which, unless some major changes happen to the union plans, I don't see any major changes happening to that. To give you an idea, roughly 40–45% we have into global equities, slightly below 30% in the fixed income, and then around 10% on the hedge fund portfolio, and then the remaining is private markets and cash. So still you can see that there is a decent amount of risk taking in the portfolio. But the open plan, because since they are open, so you have to take risk, and the return expectations are substantially high. As far as tactical decisions, we do take tactical, so even just to give you an idea, like swap spread, 30 on swap spread, we took a big trade on that. Given one of the challenges that I feel when you get to our size, the scale is a big problem, because even let's say if we do a very good trade and we made, let's say $50 million, which might seem, oh wow, it was pretty good, and we were pretty, decently hedged on taking any kind of beta risk, it's still, not even 15 basis points. So that is one thing we are now more and more realizing, that scale, again, it has an advantage because we run a very cost-efficient portfolio, I would say, one of the lowest in the, compared to our peers. And so on the overlay side, we use quite a bit on the tactical if we feel like taking more risk. And again, what is the tracking error that we want in the portfolio? What is the absolute risk levels? And one of the challenges that I felt in the last year and a half is the risk has pretty much shrunk. If you look at 60/40 portfolio, again, literally there is no, like 7–8 vol you're running in a 60/40 portfolio right now. If you have, again, that was as of last year I'm talking about. So then, what do you do if you want to take any kind of tracking error, different risk? You have to be quite a bit of different, and that's one of the challenges we have felt like last year. You were not getting, all the risk valuations shrank. So again, for us, we manage internally all these kind of things. We look at the risk, and where there are, if there are pockets where we can look at and take advantage, we do take some risks like that, on the tactical side.
Thank you. Let's turn it over to Tony, and the question is current trends in asset allocation and risk management from your client's perspective.
You bet. So, we have a broader client base, so there's going to be, as opposed to one fund specific, there's a lot of kind of things to implement beyond various portfolios. I would start out by saying, and it's not a news flash to this group, that most asset classes aren't cheap. We're elevated, and that makes it a little bit challenging. We see very few pockets of opportunity. I think it's a relative value game at this point. I would also say that we're not tactical in the sense of trying to radically time markets. We certainly will make tilts where we see things that are interesting, and quite frankly, there's not that much that's interesting right now. We don't mind saying that. So we're talking to our clients about that, again, things are elevated. So what does that mean? We're late cycle. As we all know, at some point in the next 2, 1, 3 years, we'll have our bear market. And as a consultant, I'll leave that wide open from 1 to 3 years. So, but I think what we're doing from all of our clients is re-evaluating where you are in your asset allocation, and that is so critical. So in other words, keep a simple mix with an endowment and foundation that's 70 in risk assets, 30% in fixed income. Everybody's on board, we're all long term until we actually hit a bear market, and then everybody panics, right? You don't make good decisions when volatility is elevated. And the very nature of institutional investing, at least from our client base, is you go every quarter and talk about things. I'm not always sure that's productive, so forgive me if you're a plan sponsor and you meet quarterly. I understand it. I've always kind of made the joke that people are long-term, quarter in and quarter out. So we think in this kind of environment, to summarize those thoughts, that we need to be stress testing portfolios. So for corporate defined benefit plans, a couple of things. One, returns have been really good this past year, all right? And so what you've seen, depending on the nature of the plan, is funded status has improved pretty dramatically. And so I know we're going to talk about LDI a little bit later, but that really drives the discussion, right? What's your funded status? Whether or not you're hard frozen, partially frozen, there are a lot of different dynamics, if you will, that kind of drive that decision. I think one of the things related to DB plans is folks, maybe they get to 100% funded, they're frozen, but maybe not hard frozen. What people forget is you have an interest rate or discount rate, maybe 3 to 4%, depending on your funded status. You still have service cost embedded to that, so you maybe have a 6% plus target rate just to maintain your funded status, not factoring in things like mortality and other things that keep getting moved out. So it's not that, okay, we hit 100% funded status, we won the race. It's actually far from that. And again, it's different from client to client. So that drives a lot of that decision. And then we do asset liability modeling. Again, you can do things over a 10-year period, and the more aggressive mixes look great, and so that's wonderful. What people forget is, again, that short-term kind of volatility where people get really upset. And so what we try to do is say, if that looks attractive, so be it, but understand what can happen over shorter periods. And we kind of discount back what are the greatest contributions you can put into your plan. So doing that analysis, and typically, right, when portfolios aren't behaving well, when funded status drops, when perhaps you have mandatory contributions to your plan, it's probably in concert perhaps with not so great economic times, and it's not like the CFO is walking around saying, I've got cash to deploy and let's slap a little bit in the pension plan. So you better understand that, and I think that's pretty critical. Again, though, I would say on the DB side, returns have been pretty robust this past year, and funded status has improved along with a little bit of lift this year in terms of rates, not a lot, but a little bit. You've got a long duration in your portfolio, that's really benefited funded status. So that's driven a lot of that discussion. With endowments and foundations, you know, we have large endowments foundations, we have smaller. So it really is a function of how much each institution is relying on that endowment for operations. And it varies from client to client, so you really need to understand that. And there's a good deal of pressure on a lot of the smaller educational institutions to kind of fund the organization when other financial pressures are out there, and it's a very competitive landscape, particularly with tuitions, et cetera. So taking a holistic view with the endowment and foundation and understanding that is really important. You know, everybody's got their view on what capital markets are going to deliver, and for quite some time it's been a pretty a muted look for returns going forward. We're probably in that camp. We don't know what those numbers are going to be, but if you look at typical spending for a lot of institutions, I don't know if they've reconciled realistic returns going forward with their spending rates. And so we try to elevate that conversation as well in terms of the stress testing of really an endowment is not about how much money can we grow. It's not necessarily an asset accumulation story. I mean, that's great. A lot of it is how much cash are you kicking off to support your organization and what do you need? So if you say equities, and this is maybe consensus today, that equities earn 5 to 6%, fixed income is closer to yields, you get some pretty small assumed returns going forward. If you're spending at 4% and inflation is at 2%, that math doesn't work. So those are hard conversations to have, but that's the framework that we kind of look at it as stress testing. Think about what can go wrong. If you can't live with that, okay, then maybe we should work backwards a little bit to think about what that asset allocation can be. And again, that's a little bit different on corporate plans versus endowments and foundations. So really trying to understand that and making sure that all the stakeholders, particularly the committee, is on board with that and understand that. And again, I think the biggest challenge has been in this past decade is you want to participate in up markets. Everybody likes to do that, but you better be prepared for down markets as well. And I think we're longer in the cycle where that's really kind of moved to the forefront for our client base.
Thanks, Tony. Next question is related to the blueprint for investment success, which is investment policy development, as well as implementation and modification. This question goes to Syed, Geoff, and Kipp.
So IPS, I guess, that is the main, one of the governance structure, how do you define that? Like one of the things that we are struggling right now, that in our IPS, that we never wrote a very comprehensive derivative policy in that. So how you're gonna, what is the ranges and what kind of leverage, all those kind of things. So that, again, for us, the policy statements pretty much define the ranges that what risk you want to take, and if you exceed those ranges, what the process should be. Or again, absolute risk is very difficult to define there because it's very market driven. But the approach that we have taken is that give a decently latitude on the ranges. That way, you don't have to rebalance the portfolio if it's too tight. At the same time, it's too wide, then you pretty much have what's the midpoint and where are you, how much risk are you taking. So again, we spend a lot of time on that side. At the same time, for the DB plans, if the plan is closed, frozen, and all that, that is another in the policy it comes up, because before it used to be mostly for us in terms of get the maximized return per unit of risk, or however you define that. Now it is in that language we are having in the policy statement is that what's the hedge ratio, and if we have a derivative policy, what's the hedge ratio we want to be, absolutely not want to go below that. So these are the conversations, again, we are looking into that. Prior, it used to be just looking at, from asset side only. Now we have both sides. And then the derivative policy itself is, John will add more because he has been using, leverage in the plan. And we have been using leverage up to 10% leverage sometimes, but at the max. But again, we didn't have a very specified framework of policy defined. And now we are in that context that we're working on that to make sure that, the risk that we take can be clearly defined and can be measured and held responsible. So that's, that's the approach we take.
Thanks, Syed. Turn the question over to Geoff, as far as how does an insurance company implement and modify investment policy?
Yeah, the investment policy is very important at Voya. So my colleague from Delta mentioned earlier that his liabilities are 60% of the market value of the company. At Voya, mine are 850%, right? And that's actually low for a pure play life insurance company because we have this valuable investment management franchise outside of the regulated insurance companies. So Voya, I'm trying to serve, kind of two masters, right? I want to deliver returns for our shareholders, right? We have a $9 billion plus market cap, but I also have to protect the policyholders that have regulated insurance contracts from Voya. So you end up with investment policy that's very risk aware. When we were a subsidiary of the Dutch bank ING, a global bank, a lot of the investment policy was don't do this because I have exposure to that globally. And there were categorical prohibitions about the investment management framework. We've moved away from that as a standalone company. When you look at our asset teams, and the same asset teams that manage our third-party assets, manage our proprietary assets, 88% of our funds have beat their 5-year benchmark. So you have very successful asset managers. You wanted to put an investment policy construct in place that gets away from these categorical prohibitions and lets your asset teams be your frontline risk defense in concert with enterprise risk management framework embedded in the organization. So my risk management colleagues are sitting over here. If I didn't mention that they're a valuable part of that framework, I would have got scolded on the way home. But the investment policy construct has changed. As we've went through this transition from being part of a global bank to being a standalone U.S. insurance company, And I think we're in a better place today in managing with a little bit more of a nimble investment framework than when we had a top-down categorical prohibitions.
Good job. Kipp, why don't you talk a little bit about how you interact with clients as it relates to their investment policy?
Sure. I'll take a completely different perspective. And maybe start off, I'm curious, just ask a question of the group. How many in the audience are asset owners? And so is everybody else a practitioner, asset manager, or a practitioner of some sort? Anything else? That's a big gray area. I wanted to ask that question because when we think about policy statements, I think in terms, everything everyone, the other panelists said, and I just won't repeat it, from a governance perspective and a document to help make decisions. And so Tony made a comment earlier about you really don't want to be making difficult decisions in periods of volatility. That applies to our personal lives when you're in periods of stress. Advisors tell you don't make difficult decisions when you're in periods of job stress or health stress or family stress. Policy statements help you mitigate bad decisions, which we are all human and we're all prone to make. And so we think in terms of using policy statement to clearly define roles and responsibilities and use the scenario testing to help pre-think what could happen, what could go wrong, and how are you going to react. It doesn't mean that you'll make good decisions in those periods of stress, but it means that you've already kind of agreed how you would react and make decisions. And so it flips the decision making, it flips the dynamic to why should we sell equities when equities have been the only thing that have earned money? We've made money, and everything you've told me to diversify my portfolio hasn't worked. You don't know what you're talking about. I need to own equities. When kind of makes sense to sell high, buy low, rebalance. And the policy statements are critical in helping you do that. And so I think in terms of governance, decision making, being self-aware of where we're good at making decisions and what types of environments could lead to bad decisions or suboptimal outcomes, and baking that into the process.
So suboptimal outcome is a code word for bad decision?
It's a consultant word.
Thanks. Next question is active management and current trends with managers, and also asking the question, is active management still valid? This will go to Syed, this will go to Mike, John, and Tony.
Sure. Well, working for Endowment, it would be tough to say active management doesn't work, right? Yes, I think we pretty much believe in active management, but at the end of the day, you also have to think about area where you are being active, areas where you need to be passive. For the most part, we are active, but for investments like US large cap investment, we probably use features to get the exposures and use the capital somewhere else, hopefully to generate alpha. So we are very active. We believe in active management, but mostly in inefficient markets, smaller cap developed market countries, or emerging market countries, or obviously the private side of the business. But for large cap developed markets exposure, we use passive, and we use derivative for the most part to get that exposure.
Great. John?
Yeah, so I guess my answer to this depends on, is Ben still around? Very large man. So my answer is actually going to be pretty similar to Mike, and maybe we do it a little bit differently. We don't employ any active managers in global developed large cap equity. This on the DB side. We also do not employ any active managers on the Treasury or Core Plus side on the DB side. And the reason for that is really just that efficiency of capital. So if we want to fulfill our asset allocation, we want equity exposure, we just go get the futures. If we want fixed income exposure, we just get the bond futures. Because what do we want to do with the cash? We want to generate as much return as we can. So I'm a believer in, this might take some of us back a little bit, in Ronald and Kahn, fundamental law of active management. And one of that, one of the tenets of that is, how good is your model, and then how good or is your investment process, and how able are you to translate the output of your projections into a portfolio. So a lot of people are, have pretty good processes, but then you talk to them and they're like, we're a U.S. equity manager. Okay, so now if you have a thought on anything other than U.S. equity, you can't. You're reducing your breadth. U.S. large cap growth, U.S. large cap growth, and this next one's a big one, long only. Long only is an enormous constraint. So even if you've got a great process, your ability to translate the output of your process into trades that are going to make me money are limited. So one of the central things at Delta is we want to run largely unconstrained. So we'll set aside some cash to meet our margins, and we invest primarily in market neutral strategies. So this can be in the hedge fund space, it can be in the alternative beta space. But what we're trying to get is we're trying to exceed the implied lending rate of our derivative portfolio by about 400 basis points. You've got to set aside some cash to manage your variation margin. We're trying to beat indexes by 2%. If we can beat indexes by 2% in core plus fixed income, as well as in developed large cap equity markets, we can add an extra percentage point to the overall plan return, and that allows us to take a little bit less beta risk. So we're trying to manage risk by taking beta down a little bit and really kind of leaning on alpha, and that precludes us from doing too much in funded, constrained active management space. But don't tell Ben.
Our secret. Tony, talk to us about your clients and the role of active management.
Sure. I think part of it, it doesn't have to be an either-or discussion. So we have clients that have active management. We have clients with passive management. I think it's hard to argue against passive management in any environment. We all know to the extent that you can lower your fees, that helps. It's just factual, simple math. But we do have a blend of active and passive, and of course in large cap and more efficient asset classes that becomes more challenging than more inefficient asset classes overall. I do think that these cycles, and we know the knocks on active management, particularly more recently over the past 10 years, these things can be cyclical. And maybe a topic for later on too, but quantitative easing, some of the environments where all boats are lifted, that makes it particularly challenging for active management. We certainly appreciate that, but it's been a reality. And having said that, if you look at, and it's a short amount of time, if you look at last year, you saw more stock dispersion, you saw more idiosyncratic volatility, you saw returns that from the active management side were actually pretty reasonable. So that was, to the extent that you had that, that's reasonably refreshing. So I think the other thing, when you think about it, we haven't had a protracted down market. So I do think active management may have a bit of an advantage in that kind of context, where just simple things like holding cash that most index funds don't do, you have a little bit of a head start at the margin. And again, kind of managing on the downside can kind of help you. So, but having said that, yeah, on large cap, there's a healthy amount of indexing that we do. And then on other inefficient asset classes, we think it's there. A couple other points I would think. I don't think active management is dead. We recognize the flows into indexing and out of active management. I think it's going to be interesting to see what price discovery looks like in this next down market. So you have fully invested index funds, et cetera. You have probably, and this is a broad comment, that active managers under pressure from not outperforming in up markets have less cash. So who's going to step in and be the marginal buyer in that down market? That's going to be interesting, and I don't know if enough thought has been put into that. I think the other thing I would tell you, if you look at studies, active management, whether, pick your number, is it 20% that outperform over time or otherwise over like a 10-year period, right? I think there's some potential flaws in some of those studies in terms of a lot of it maybe it has to do with mutual funds, that if you're reasonably diligent, there are a lot of things that you can eliminate, meaning extraordinarily high expense ratios on mutual funds or other things that you can stack the odds a little bit more in your favor, maybe not dramatically, but a little bit more. Having said that, I think one of the challenges is having the committee that you may have to interact with on board. So in other words, if you said, pick a manager, do your best work, come back to me in 10 years, take a nap, wake up, and let's see if you outperformed, right? You may have a reasonable chance of doing that. If you said, okay, by the way, never mind, you got to stay awake the whole time, and every quarter you got to go to a committee to defend the inevitable periods of underperformance, that becomes more challenging. And that's a reality, and that's where we think you got to read your client, and you got to read your committee. And if it's just a reality that some people say they're long-term and they're not. Some people, and I don't mean to say that from sounding arrogant, if you will, some people get it, some people don't. That's just a reality. And so, you know, you can say that this is a great manager, 30 stock portfolio, high tracking error. You know, at the end of the decade, you may have in fact won, but if you can't get it through those inevitable underperformance cycles, then maybe you shouldn't try. And I know that's our job to kind of mediate that, but there are just some hard, cold realities in terms of, again, meeting with clients on a quarterly basis. And, you know, many times, and this is one of the challenging things to do in all of our world, is to be patient and do nothing. You know, it's Ronald Reagan's quote of, you know, don't just do something, stand there. So that many times doesn't translate very well to a committee. We need to fix it, you know, get it right. And so again, I think you can potentially make bad decisions. So to summarize, and if I said anything at all, I think there may be a more palatable environment for active management going forward. We do think there's an element of cyclicality. I don't think it's all or nothing. And I think understanding your client and the tracking error that they're willing to tolerate, and don't lead with your chin if it's not a group that buys into active management. It's just not going to work.
Would you like to see less frequent than quarterly client meetings?
I've said that twice. What a self-serving comment. So I don't mind quarterly. I think the fact that you get together quarterly can inevitably lead to the need to take action. So I think if you could stretch things out a little bit, you might do a little bit better. Again, it depends on the committee, on the constituency, what people have bought into. But if we say we're long-term investors and we tell everybody that's investing in 401k, our friends and family, don't look at it, look at it twice a year, maybe rebalance, and yet institutions are going to meet formally quarterly. And I get just the need and the governance, the feeling that that's right because you're watching it, right? One could take a step back and say, is that always served all institutions well? It depends, but yeah, it might be better to look at it a little less frequently.
Any questions from the audience?
While we're talking about performance and underperformance, can you tell us what is the time horizon that you allow an outside money manager to underperform before you finally pull the plug and move the money to someplace else?
3 weeks.
You want me to start?
Tony, and won't take Kipp.
Everybody.
Yeah, we're exceptionally patient when we understand what's driving the underperformance. We understand the manager's core skill set and how the manager is investing in the market, and we can be exceptionally patient over the course of a number of years. We've got a manager that's one of our most highly rated managers, happens to follow a value-oriented process. And the rate environment and the chase for capitalization names has just not been an environment that's conducive to their style. Started to turn around in the last few quarters, and we fully expect that to be the case. We have others where we'll be exceptionally quick to pull the trigger. Those decisions are usually more tied to something's changed. So when we come up with a rating and an investment thesis for a manager, we tie specific review factors. So if person A resigns or gets hit by a bus, automatic review. So we have pre-identified those flags. But if it's just market performance, we can be pretty patient. We can let that go for years if we think that it's worthy of being patient.
I guess, not surprisingly, we like diversification, and that happens in active space as well. So the way that I do it with my committee, and it gets back to kind of that governance question. We do meet quarterly. We do meet 2 hours. That's to discuss DB and DC. So I mean, our time is pretty abbreviated. We do have a lot of managers as well. Maybe not quite as many as Emory, but we've got quite a few. So the way that I've structured things is I don't want to talk about managers in front of committee. I want that to kind of fall within my realm. So I've got these buckets, right? So I talked about portable alpha a little bit. What are my expectations for portable alpha? I expected to add 1 percentage point of value at the overall plan level, and I've got tracking error bands around that. I talk about portable alpha. I don't talk about any of the 30 managers underneath that. What's our expectation for traditional managers? We expect traditional managers, where we still fund them, emerging market equity, emerging market debt, high yield, a couple others. We expect traditional, fully funded, constrained, long-only managers to add 15 basis points at the overall plan level. That's our expectation. What's our range around that? You should be questioning me about our processes to pick managers if at the aggregate level, we're not getting done what we're saying we're going to do. So I try not to talk about managers at all in front of my committee. I can include the lists in the appendix, because again, you've got to have the fiduciary kind of paper trail for everything. I try not to talk about managers at all. And then again, due diligence process tends to be pretty good on the front end. So I mean, you've got to be able to weather 3, 4, 5-year periods of underperformance. And the thought process is, if you're aggregating all these managers, you should have some outperformers offsetting some underperformers. We can be extraordinarily patient.
Anybody else want to weigh in?
I guess, we are very similar to Delta in the case of managers. When we go to the committee, we don't talk about any managers. So it's more on the asset class, what we have done. And for the managers, again, given we monitor the managers pretty closely, it doesn't matter quarterly, whatever the information they send us. So we will know before what they, So like some examples, we are, as long as the manager can explain us if there is underperformance, why it happened, did they deviate from the strategy. So I'll give you an example that one manager started holding ADRs in the US large cap portfolio. First it was small percentage, then it became a bigger percentage. To us, that is, why do you have to do that? Is that, you are not able to, why do you have to deviate from that so much strategy? So those are the conversations we will be having. And again, because we are on the top of the portfolio. At the same time, we are pretty patient in that, in terms of, we had managers, who had, a bad period for 1 year, 3 years, 5 years, and we still had them in the portfolio. As long as we can fully understand, and they are not deviating. If you are a value manager, let's say, and you are behaving like value, and value is having a hard time. Again, we had a manager that we put them in the small cap space, and this value underperformed, the small cap value underperformed small cap core, and the manager underperformed small cap value. So for us, from asset allocation side, if you think about that, we are having a double whammy there. But at the same time, we believe in the managers doing what they have told us. We believe active management in the small cap space. So as long as we can fully understand, and there is no deviation in the strategy, we can be pretty patient.
Just one thing I wanted to add is I don't select managers at Emory, but during my time when I was allocating capital and also working with different asset owners at MSCI, I'd like to offer a different view. We had a manager retention policy that was centered around what we call the 4P, the people, the process, and people, philosophy, process, and performance. And performance, we have a 5-year chart where we were trying to determine whether a manager was adding value, if its adding value is by skill or lack. And if it's statistically driven con chart, but if it follows below that lower threshold, that would automatically put the manager on watch, and we have to re-underwrite the manager. We never had to really report to the board like John and Syed described. We usually provide the committee a very big picture of the overall portfolio performance, and manager retention and termination was within the CIO's purview, and we don't, as long as we understand the manager, and even after going through that re-underwriting, as long as they're doing what we expect them to do, we don't typically rush to terminate the manager. But what I've seen in my prior work, as well as working with different clients, is actually what Tony talked about, which is there are also additional behavioral biases that comes in play. You have staff turnovers, and different staff bring different views in terms of how the portfolio should be run. And we tend, at the end of the day, what I actually noticed is we go after managers that have done very well. We buy high, and we keep them for 3 years. We do bad, and we sell them at the end of the 3 years. That tends to be honest with you, the typical action of many asset owners. And for those asset owners, indexing is perhaps the right strategy, because it would do much better than really adding managers that perform very well and selling it low at the end of 3 years.
Maybe just one other theme, I think we maybe covered to some degree, but you know, everybody, most investors would agree that diversification makes sense. But I think diversification gets confused with alpha, and they're not the same. It's risk reduction. So that's one kind of theme, and by definition, diversification means that some things will be working and some things won't. So that theme of, you know, to the extent that you can look at the total portfolio, as opposed to playing whack-a-mole on which manager underperformed, is probably a much more productive exercise, and getting buy-in on that we think is just so important. And you know, the other just simple, these are simple observations, that you can have a manager that has one bad year, right? It can be pretty bad, and that year trails and rolls into that performance for quite some time. And we'll go to meetings, and you know, it was one bad year 3 years ago, and the 3-year number still stinks, even though the other two are okay. And people will say, well, this manager's been underperforming for 3 years. You know, and again, these are very simple, granular conversations, but you know, reminders of what kind of happened, what the context was, and if that manager owned certain assets that caused them to underperform, hopefully, if you've done your job right on the upfront, there are other things that were working. So, if you have everything working and every manager doing well, you're probably not diversified. And I think that gets lost a lot of times. So that upfront discussion is, I think, really, really important in understanding what role each manager plays in a portfolio. And it's we get that question a lot: when, how long? And it's a frustrating, perhaps, response. I don't think you can define it. I think everyone is different. I think you have to put it into context of what's going into the market, what's going on with a specific manager. Is it consistent with what you thought you were buying up front? If it is, then you probably need to be patient, even though the benchmark and the manager, there's a gap there. So it has to be put into context, even though at times, again, what I said earlier, there can be a mentality of let's fix it. And to your point, what that can lead you to is chasing performance. And it still happens, and we try to avoid it as much as possible.
Any other questions?
Hi, yeah, I have a question that's directed more towards Tony, John, and Kipp. You guys all mentioned delegated, discretionary, OCIO. The consultants talked about, you know, your business lines in that space. John, I know you mentioned you guys are moving away from that and more towards an in-house operation. I'd just be interested in kind of hearing additional thoughts on that trend towards delegated, and in Delta's case, the move away from it.
Okay, so maybe I'll start. So, you know, Tony said a lot of good things during the course of the panel session today, but it's just, you know, the objectives and the alignment, you just have to be very clear about things. And, you know, Delta has been through this very long cycle. It's had painful parts and it's had good parts, but one of the painful parts was as we were going through bankruptcy. So we're going through bankruptcy, there's a 40% across the board salary reduction. It's pain. This is pretty extreme belt tightening. And now let's look at the pension staff. Well, the pension staff has got their own office, they've got their own titles, they've got their own compensation. It doesn't matter to them that, you know, our arrival time, you know, wasn't good, or we lost too many bags. Why are those guys getting so much money? And when everybody else was belt tightening, it just, the aesthetics were just flat out bad. So as we were in the bankruptcy period, the CFO and the treasurer had a decision to make. Were we going to rebuild a pension staff, or were we going to look at a different model? And at the time, this is in 2006, 2007, Delta decided that the OCIO made the most sense. Yeah, you know, I'll spare you some of the other background on this. We've got special treatment that's called airline relief that we've got until 2024 that establishes what our minimum mandatory funding is. So Delta's, we want something that's very simple, we want something that is very cheap, and we want something that is very easy to oversee. And that's what they wanted, and that's what they wanted for all the right reasons, and that's what they got. So we finalized it in 2007, went straight into the financial crisis with an equity bias and, you know, predictable results, not abnormally bad, but just the results that you would expect. That volatility worked its way into the financial statements of the company, where the minimum mandatory contribution went from about $150 million a year to $700 million a year. This called for heightened risk management. One of the, I'm not trying to insult anybody, one of the, you know, potential weaknesses of an OCIO model is in inflexibility to truly customize. I mean, it's a tough, OCIO is a tough business, and providers will lean towards scale where they can. Because if they truly customize and try to wear the same shoes that I do, it's just really not manpower efficient at all. So what the CFO found at the time was, you know, we needed to do enterprise risk management around the pensions, and whoever the provider is needs to understand the cyclicality of the business, the business strategy, the company, the access to liquidity, the earning cyclicality, credit rating, all of that, and have that influence, what the contribution strategy is, and have all that influence what the asset allocation looks like. And it's just really hard to do because Delta at one point in 2012, we were 38% funded with a 9% expected return. That's not a model that you just pull off the shelf. I mean, the whole company, has to kind of rally behind that. So there was a decision that Delta wanted, thought that from an enterprise level, we could manage the risk more efficiently if we had a hybrid model. There's still, these plans are frozen, they're legacy assets. I am the managing director of pension investments. I will never, ever, ever be the CIO. There's no appetite for it. We have to, if you ever get a survey, if you fly Delta, I encourage you to do so. If you get a survey, how you fill out the first 2 questions of that survey directly influences my compensation. So it was just kind of, it was the cycles that were particular to Delta.
I would say, I would add to that, I think John's exactly right. I think nobody should buy OCIO just because it's OCIO. It's fit for purpose. I think the early days, there have been a number of solutions from consulting firms and asset management firms that are just pushing a solution. And then on the other side, there's been a number of plan sponsors that are buying OCIO for very specific reasons. We've seen a lot of early take-up in the environment, the marketplace, in the pension space by closed, frozen, fairly well funded, but not ready to defease and sell to an insurance company. So it's very close to autopilot, and it's just scale, simplicity, lock down the volatility of my funded status. We've also seen it come from plans in that similar situation, and there's no appetite to continue to support staff. It's not going to be a career opportunity for the next generation, so I'm not going to attract and retain talent to manage this portfolio. That's another reason to buy. Scale is another reason to buy. Our firm's come at the market from the top down, and so we've advised companies from an outsourced delegated perspective for, 10 or 12 years, and we started with 1 or 2 or 3 very, very large companies that were undergoing organizational stress. And so we built a very bespoke, customized solution, and now we're building a platform to roll that out to a larger number of clients. But I would say it starts with, you should know why you're interested in what your goals are, what risks you're trying to manage, as opposed to, well, everybody's buying OCIO. I think for a large number of plan sponsors, the drive for OCIO is better decision simplicity and a more inexpensive path. Whether it's accessing investment management strategies using a firm like mine, our scale and buying power, or just making better decisions and avoiding those surprise contributions that you didn't plan for.
And I don't think Delta was wrong back in '07. If it wouldn't have been for the financial crisis, I mean, easy thing to say, they'd probably still be full, outsourced, simple OCIO.
Yeah, I echo a lot of different comments. There are a lot of different flavors too within OCIO, and I think we kind of alluded to it a little bit. So there's kind of the model of customization versus kind of block building funds, you know, more, I don't want to say cookie cutter, but, you know, more formulaic, if you will. So in that market, it's really blurred. And I would even say with our client base where we have non-discretionary clients, I'm not sure that in many cases we aren't, to some degree, an OCIO to begin with. In other words, we make a recommendation, the committee blesses it, but again, depends on the institution. There may not be a lot of questions. It's more, got it, that's why we hired you, let's move on. So a lot of different flavors along the spectrum, if you will, to the extent that, and again, a lot of different reasons why that market's driven up, to the extent that a committee says, hey, we don't feel like we have the expertise, or maybe we're making bad decisions, so you take it, fair enough. To the extent that it's perceived as a silver bullet, or we're going to get much better returns, I think that could be a flawed view. Or quicker decisions are going to be better, or inter-quarter decisions are going to be better. I don't know that that necessarily gets you to a better place. And you know, cost management and those kind of things in an institution can be a very big deal. So do you want to build it, or do you want to send it kind of out to begin with? So a lot of different factors. And again, for our client base, given, you know, again, the gamut of size, even on our non-discretionary side, I'd say, again, there's some element of OCIO, even if technically we're not called that.
Let's shift to a question on ESG investing initiatives, and I'll point this to Syed, Mike, and Kipp.
So ESG, we haven't made any ESG, but again, it's an interesting question. It keeps on coming up, and so far, again, we believe that it's not an asset class. Again, what is an asset class? Either you having some kind of risk transfer, or there are behavioral reasons for that asset class, or there are structural impairment. So we think of that ESG as a more from the governance side. In the Europe, there's a lot of discussion happening. And then they are taking from that side that how, if you want to have a governance structure, and then from that you can say that you don't want the portfolio to have certain kind of exposure. From an asset class, that's why it's hard to take why it can be an asset class. At the same time, you know, if you bring and again, the important question is people have to think about the fiduciary role that comes in if you take that as an asset class. So if you exclude, you know, certain type of companies, why, you know, that is, as long as it's clearly defined in the policy statements, then it becomes an easier problem to manage. But otherwise, again, I've seen some research recently that, you know, certain portfolio or index providers have shown that ESG portfolio has done well, but that's a huge sample bias. You can say that, you know, you have to be careful about that. Again, at the same time, you know, if it's a core philosophy of the company and it aligns with that, then I would say take from the governance side, and that's how it should be implemented. Again, that's the way we have been looking at it.
Yes, my comments are somewhat consistent with Syed's. So if we take a step back, right, if we look at the big picture, ESG is mostly driven by one of the three potential stakeholders. One is the board or the investment committee, trying to, really carry on their fiduciary responsibility and making sure that the portfolio is aligned with the values that matters to the organization that the portfolio belongs to. Second one is the investment case. Investment case, there is a risk side and the return side. The return side, it's been very two-sided. I mean, I think early research indicate that there is no alpha associated with ESG tilt. Recently, I have seen research that says there is alpha, there is excess return. So I think that's up for debate. The risk side, really excluding companies that are, bad for society, and was it in the world of the environmental issues or social governance issues or other ESG attributes, that could be actually a way to mitigate the risk. Avoiding Volkswagen, if you could have avoided because Volkswagen had bad rating, could have potentially mitigated some of your risk. So there is some case to be made on the risk side. The third one is the external stakeholders. That is, in our case, students, faculties, and some cases as their beneficiaries. They come into you demanding you need to do something. So I feel like those are the frameworks that I have seen ESG being applied. It means different things for different asset owners or plan sponsors. But for us, we believe our managers that we select do take care of the S and the G. It's because it's part of the overall DNA. It's a part of the overall investment process. E is not something that we think we have a strong coverage, and we are in the process of actually looking at that as well.
Kipp?
I would say ESG or sustainability is an area that everybody should be talking to their clients about. I think it's an area that there's lots of questions, lots of development, lots of opportunities. As I said, mentioned in Europe, we're actually starting to see asset owners and asset managers be regulated into incorporating ESG or sustainability components into their processes. We're starting to see that from the asset management firm BlackRock most recently, expressing their muscle around companies and environmental governance types issues, societal issues. I think it's important whether you're a supporter of those topics or not from a personal social perspective, but to be aware that they are impacting the markets. Our view as a firm is that we're likely to see more and more pressure from a sustainability perspective, and as an asset owner, it might be a good idea to be an early adopter and be thinking about these components. For example, just very simplistically, from an environmental or sustainability perspective, in other countries, Australia for one, you've seen airport systems building in renewable energy sources to lower power bills, lower the carbon footprint. That's a business opportunity. It's an investable opportunity for asset owners from an infrastructure perspective. It's a very simple way to think about sustainability is something that's growing globally, and there are opportunities that you can capitalize on as an asset owner.
Thanks. Next question is the use of alternative investments. Are you increasing or decreasing allocations? And what areas look attractive in the alternative space? And this is to John, Geoff, and Tony.
All right, I'll start with apologies because I'm actually going to have to leave myself here reasonably soon. So for alternatives, it matters a lot that we're frozen. We've got to reduce our allocation to privates, and we actually change our allocations to privates a little bit. So what we've been doing for the last 6 or 7 years is we're targeting a stable NAV for our private portfolio. And the thought is we're underfunded, fairly deeply underfunded. We've got work with the sponsor, understand what the contribution strategy is. Our belief is that the asset base should come up. If we target a stable NAV, that should gradually bring our allocation of privates down. I mean, you've got to think about liquidity around this. Also, within privates, we do try to shorten our duration. So we're pretty meaningful users with a strategic partner of both secondaries and co-invest, where they're both about kind of between 20 and 30% of our private book. There's more to secondaries than just kind of premium or discount. You'll find that if markets are going straight up, if you can underwrite the valuation process of some managers, you can pay fair value based on marks that are 9 months old in an upward rising market with a general partner that marks conservatively. So even just because you can't get 80 cents on the dollar, we paid $1.03, $1.05 before and gotten 20% IRRs out of that. So that's to try to, we've got a little bit more credit, a little more co-invest, a little more secondaries to shorten the duration, but we've got to bring the allocation to everything down a little bit. On hedge funds, as I mentioned, hedge funds are a lot of things to a lot of different people. We eat in a fairly small corner of it. I don't like to pay 20% incentive fee on beta. So basically, I kind of look at funds that have a beta between kind of positive 0.2 and negative 0.2. They need to short, and that's kind of what we do on the portable alpha side. We are always going to be in the market for alpha, or at least until we get a significant farther way down the hibernation path. What looks interesting, I mean, this is going to be a little bit old school because this does a lot. What I'm going to say has not looked interesting in a long time, and part of it to Tony's comments about the general unattractiveness of a lot of things out there. The convertible arbitrage market has changed a ton. It used to be dominated by hedge funds. It's now dominated by the convertible bond market, that is now dominated by long-only players. I actually kind of like convertible arbitrage in this at this part of the cycle. I kind of like boring old merger arbitrage as well. We've seen a lot of fiscal stimulus poured into the world. I think we've seen obviously corporate tax policy change. I think that manifests in more events. I think that lends itself towards more M&A activity. So I like that, and I also like the event space in Asia. I think it's a very active part of the world. I know it's general. I can get more specific if we need to. But Joe's in horrifically bad form if I leave right now.
Do what you need to do, John.
All right. Thanks, everybody.
At Voya, we're likely to be increasing our alternatives allocation on the margin. And that's a function of a transaction we're undergoing with our annuity and variable annuity block. As you probably saw, just front page of Wall Street Journal, we've halved off that business in a transaction to Apollo. And so if you think about our balance sheet, that variable annuity business had some equity market sensitivity on the liability side. So now you have, you could potentially take a little bit more risk on the asset side. You've reduced the risk on the liability side to have the same amount of equity volatility that we've been experiencing. So we're likely to increase asset risk on the margin over time as we see opportunities. And for us, that means some amount of money shifts from fixed income, which is obviously the big part of our fund, just giving the inherent operating leverage into alternatives. I think it's going to look a little bit different than what we've done in the alt space in the past, right? We've been buyers of secondary private equity and hedge funds. I think at first we're going to leverage our internal capabilities. We do have an internal private equity capability, but I think first we'll leverage our internal capabilities in part on the fixed income side. We have a CLO platform run out of Scottsdale, that has a history back through the pre-crisis period. The return on equity of our CLO platform has never been below 10%. I think the lowest is 12%. Ned's mind, correct me if I'm wrong. He's shaking his head, so that's confirmation. So, doing a little bit more on the CLO equity of Voya managed CLOs is something that we could do in the general account. We have a great commercial mortgage loan origination platform. If you go back to 2000, that platform has averaged about 5 basis points of credit losses on their loan book, which is exceptional given that there was a big real estate downturn, obviously, in that period. We don't want to go from their traditional core 60 LTV lending and tell them go out and get us, closer to equity-like returns at 80, 90 LTV or be an equity owner of real estate. Instead, we're going to go out and we're going to add external leverage and have a commercial mortgage investment fund, still kind of similar to our knitting commercial mortgage lending, but with a little bit of leverage to get closer to equity-like returns. As a lot of you probably in the audience know, Voya has a long-standing, very successful internal mortgage hedge fund that takes bets on prepayment risk. That's been an uncorrelated source of return for the portfolio for a long time, and that could be a place where we add incremental dollars over time. So in the short run, we're going to leverage our internal capabilities a little bit more with this bandwidth that's opened up on the balance sheet with the reduction in the risk of the liability side. Over time, that might be, increase our allocations into, traditional types of alternatives. I think generally insurance companies have kind of missed this a little bit. You've went fixed income, and then you've went very expensive construction of alternatives portfolios in the highest fee type asset classes, and we've skipped public equity. Voya has a public equity shop run out of New York. I could see us having a little bit more public equity on the balance sheet, just given that with the transformation in our balance sheet, you don't necessarily want to be in alt space in all illiquid asset forms. So I could see us having or less liquid asset forms, having a little bridge there in public equity as we kind of examine what we want the balance sheet to look like going forward.
You have some regulatory restraints also, don't you?
Oh, certainly. Yeah, that's to the question about active management. It's got to be active when you're talking about multi-jurisdiction regulatory framework, the amount of leverage we operate with, and just sitting the investment portfolio in this big operating business. But there are definitely capital constraints. Risk-based capital is an important part of managing insurance company portfolios. Our holding company, the lifeblood of Voya Financial is dividends from the operating entities, and you dividend money out at the, at the blessing of state regulators. So you've got to conform to all the risk-based capital ratios, and alternatives are certainly more capital intensive than fixed income. We do have some space on our balance sheet. It's very nuanced insurance stuff that I'm not going to get into, where we could make some of that work on our balance sheet, and we'll evaluate that over time.
Tony?
Yeah, for us it's more nuanced just because we have so many different clients. So it's hard to say as a broad brush if we're increasing or decreasing alternatives. I'll try to break it down a little bit in terms of asset class to some degree. And if we look at private equity, the themes of what I said earlier on, things aren't cheap. I think a great deal of capital is moved into private equity, so that gives us concern. There's still the cash overhang within that, so it's not that we're not there, but we're being very selective on who we look at, on how they deploy capital given valuations. I think on some level, with a lot of large plans, the movement to get returns is that it's gospel that you get S&P plus 5, and that we don't think that's true. And so that, by nature, the more people are interested, the more that drives down returns. So we're cautious there. Interesting things in terms of in that asset class where in order to increase IRRs, more bridge financing, more leverage effectively going into those strategies, which, again, it's case by case, but you really got to be careful there as well. In terms of hedge funds, again, such a broad brush, so many different strategies. Long short equity, we actually do think is reasonably attractive in terms of the environment that we've been, where perhaps shorting is more attractive, not just because of perhaps at some point quantitative easing ends, but also just the short rebate, interest rates increasing, that becomes a little bit more of a tailwind as opposed to a headwind, where it's been enormously expensive to short, and just the risk environment that we're in. So we don't tactically increase that from a view, but we certainly would maintain, and from our overall kind of risk perspective, consider that a reasonably attractive area. Absolute return, some of the things that John talked about, I think are relevant there as well. I think to the extent that how you think about that in a risk budget framework, that if we get into a down market, a lot of people position that as a fixed income substitute. That's all well and fine. We'll see if the next downturn behaves like the last one. It probably won't, but it is a risk asset, and you have to be careful about that. So if you call it a fixed income substitute and you're counting on that to provide nice stable returns in the next major downturn, you better know what you have in the portfolio. So that's the way we kind of think about that. real estate, to the extent that you consider that alternatives or not. I mean, I think, again, elevated valuations, the major markets, cap rates, in certain situations are crazy low. We are trying to be, again, judicious where we're allocating capital there. For any real estate manager in the room, it's not meant to be offensive, but we do hear a lot of similar themes where apartments, multifamily is attractive, where industrial is attractive for, call it the Amazon effect, and folks are shying away from, the suburban mall. We get why that is. A new term, experiential real estate, which is, restaurants, movie theaters, boutiques, people like, and, in town or more urban-oriented type anchor retail where there's a Whole Foods and walkability and that kind of thing are more of interest. Again, the scary part is we hear that from a lot of different folks. So where we're allocating capital, again, maybe a similar theme to private equity of being very mindful of where we're putting that money to work, being cautious, knowing you can't time things, but you're really kind of mindful of that. So I think, again, it ties back to what I said earlier in terms of asset allocation. It's not an either or that we're broadly increasing. It's what's appropriate for your specific fund and what looks reasonably attractive and what fits.
Thanks. Next question is for Syed and Kipp, and this relates to liability-driven investing. Have you implemented, and what were the factors around that?
Yeah, I guess absolutely yes. We are in the midst of it. So, again, any corporate DB plan, they have to be full, either whether they're investing or not, they have to be liability aware. Because a good thing in the case of corporate pension, you have a very well-defined liability. So you have to be always aware of that. Whether you manage around that or not, that depends on your, sponsor, contribution or risk abilities, how much they want to take risk. In our case, we were definitely aware and had an allocation to fixed income portfolio, which was tracking the liability. So, but given now, for the company, the balance sheet has become very important. So now the focus has been on the liability side. Again, and plus in the liability, you have to be aware of what are you. Open plan, closed plan, frozen plan. And again, it depends on how hard and fast these are. Like in our case, there are two plans that are open. The management plan is closed, but it's going to be frozen. But again, it's going to be frozen in 5 years, not immediately frozen. So what do you do in the meanwhile? Because what's service cost? How are you going? If you go fully M&I, then what about service cost? What about the if you're 85% funded? What's the coverage? Because your assets will only cover 85%. So what do you do for the remaining 15 on the discount rate side? So that or the plan sponsor contribution, plan for the next few years. What is that? So all these comes into play, and then the timing is also, like in our case, like 5 year is the number that they have decided. So yeah, again, all these are part of the liability sale. And then, if you have a certain hedge ratio, then you have a certain funded status wall. And what is that wall number? Are you comfortable with that? We were, like right now, our wall is in 5-6% wall, but again, we were much higher before, and the company was fine with that. But now, definitely, the desire is much less. So again, this is a much more closer conversation with the broader company also in the LDI context, where I see that especially on the treasury side, where they think the balance sheet, what the future need is, and where the contributions landscape they see, if there is a company who wants to invest a lot into the business side and they don't want to invest in the pension side, and for them this risk has to be managed. So again, all these play into the decision making of LDI.
Kipp, tell us about your clients in LDI.
Yeah, I'll be quick. I know we're hitting up on time and everybody's got to go. I'll just give you an example of how we think about LDI. 12 years ago, if you were managing a portfolio of pension assets and you reported to the CFO or the board that good news, I outperformed the benchmark, I only lost 2% and the markets were down 5%, or the markets were up 8%, we were up 10%, but interest rates fell and the liability grew by 20%, nobody really cared. Everybody cares now. So you could show up to your board CFO and say, we generated a return of 6% last year, but interest rates fell and our liability went up 10 or 12%, and we lost a bunch of ground, and now you've got to put in $50 million in the plan. That to me is liability-driven investing. It doesn't mean that you have to be invested in all long bonds. It means your investment portfolio has to be invested in a way that's aware of the behavior of your liabilities. And I don't know that I have any clients that don't think that way. I have some clients that have a very low hedge ratio because they're underfunded and they have lots of equities, but they're aware of the dynamic. I think to me that's the framework for LDI.
Why don't we take a few questions from the audience, and I realize we need to wrap up, but are there any questions? Did we provide all the answers? Let's thank all the panelists. I think we're done.